The debt crisis no one talks about. Is a global financial collapse coming? Global debt has surged dramatically, reaching unprecedented levels of approximately $323 trillion in 2025, representing more than 3 times the global GDP. This growing financial burden raises significant concerns about economic stability worldwide. Yet, despite its magnitude, this issue often remains overlooked in public discourse. United States debt situation. In the U.S., federal debt now exceeds $35 trillion, over 120% of GDP. Driven by pandemic-era stimulus, massive infrastructure spending, and sustained budget deficits, this debt burden is causing rising concerns among economists. Servicing this debt has become a significant fiscal challenge, with interest payments projected to consume around $12.9 trillion over the next decade. The Federal Reserve's response, raising interest rates to combat inflation, has further compounded the issue, significantly increasing borrowing costs and raising risks of economic slowdown and recession. Recently, Fitch Ratings downgraded the U.S. government's credit rating from AAA to AA+, highlighting concerns over fiscal stability and repeated political battles surrounding the debt ceiling. This downgrade underscores growing market anxiety about U.S. fiscal governance and long-term debt sustainability. China's growing debt crisis. China is grappling with an unprecedented buildup of debt, particularly within its property sector and local governments. Officially, China's government debt is about 70% of GDP, but hidden liabilities, especially local government financing vehicles, LGFVs, push this figure closer to 130%. Corporate debt in China, primarily held by state-owned enterprises, has reached approximately 123% of GDP, while household debt, primarily mortgages, accounts for another 61% of GDP. The ongoing property sector crisis, ignited by major developers like Evergrande and Country Garden, has added significant stress to the Chinese economy. The crisis has stalled projects, decreased land revenues for local governments, and caused ripple effects throughout related industries. Beijing's responses, including monetary easing and fiscal support to developers, have provided limited relief. Experts fear that a disorderly implosion in China's property market could send shockwaves throughout global financial markets. Europe's debt challenge. Europe presents another complex debt picture, characterized by significant disparities across member states. Southern European countries like Greece, 164% debt to GDP, Italy 137%, and France, 112%, carry unsustainable debt levels compared to Northern European counterparts like Germany, around 65%. The European Central Bank, ECB, previously stabilized markets through extensive bond buying programs. However, with inflation persistently high, the ECB has tightened monetary policy, increasing borrowing costs. This has exacerbated fragmentation risks within the Eurozone, pushing borrowing costs higher for indebted nations. Italy, in particular, faces significant refinancing pressures, potentially threatening broader Eurozone stability if market confidence erodes. Developing nations facing debt distress. Developing countries, notably in Africa, Latin America, and South Asia, are experiencing severe debt distress. The IMF notes that more than half of low-income countries are either in or near debt distress. Nations like Zambia, Ghana, Sri Lanka, and Pakistan have recently faced severe financial crises and restructuring efforts. Currency depreciation, driven by a strong US dollar and rising global interest rates, has exacerbated these issues, inflating the local currency cost of servicing external debt. This financial stress diverts funds from essential public services like healthcare, education, and infrastructure development, further weakening economic growth prospects and increasing social tensions. Potential for global financial collapse? The interplay of high debt, rising interest rates, geopolitical tensions, and economic uncertainty creates a fragile global economic environment. Analysts warn that a major financial shock, such as a default in a significant economy, could trigger a domino effect. Already, market volatility, slower global growth, and currency depreciation in emerging markets signal potential early-stage risks. However, a complete global collapse is not inevitable. Policymakers worldwide have tools to mitigate these risks. Effective monetary policies, prudent fiscal management, coordinated international debt relief initiatives, and structural reforms could help prevent the worst outcomes. Mitigation strategies and outlook. International institutions such as the IMF, World Bank, and G20 are working on initiatives to restructure debts, provide emergency funding, and prevent contagion effects. Proposed solutions include implementing stronger fiscal discipline, transparent debt reporting, independent debt restructuring mechanisms, and fostering sustainable economic development practices. While global financial collapse remains a possibility, proactive measures and international cooperation can significantly mitigate these risks. Ensuring a sustainable economic path forward requires collective effort and prudent financial management from global leaders. Conclusion: although the global debt crisis is alarming, it does not necessarily predict inevitable collapse. Instead, it underscores the need for proactive global policy measures, increased financial transparency, and coordinated economic management to secure a stable economic future for all.